Good afternoon, everybody. Scott Riley with the Market Update Desk, powered by Mortgage One. Well, we got through the first weekend of March Madness, and somebody, I'm just saying me, is actually leading our office pool, so I want to give some kudos to me. Well, we've got a new week started, and a little bit slower today, which ramps up significantly midweek to end week. So today we had a couple Fed members speak about what their opinions on where we are and what we should be doing. Specifically, Fed President Austin Goldsby spoke this morning and said he was in favor of 3 rate cuts yet this year. That's a good sign. And he said that even though inflation progress has stalled for now, it has not fundamentally changed. And the 7 months prior to the start of the year, when inflation came down significantly, were not just random. So he's looking at some good long-term empirical evidence there. Goldsby also said that the Fed needs to strike a balance of their dual mandate between employment and cost of money. This is a nod to maximum employment as well as inflation. So he likely wants 3 cuts this year as the unemployment rate has been rising. Atlanta Fed president and voting member Raphael Bostic, who's much more of a hawk, also spoke this morning and said he would be in favor of 1 rate cut this year. Says he's definitely less confident than what he was in December, that inflation continues to fall and he's not sure inflation will continue to fall quickly to the 2% target. He did say that he expects little or no change to the 3.9% unemployment rate, which means if it keeps rising, which we think it will, he could be in favor of more rate cuts. On the balance sheet side, he said he wants to avoid volatility from the runoff, showing that he is likely in favor of reducing the balance sheet runoff, or quantitative tightening, QT, over the next 2 meetings. So we have a couple opposites going there. Definitely one more of a dove, one more of a hawk there. Interesting on the unemployment that he specifically called that out, Atlanta President Bostic, because realistically, that 3.9% that the Fed is thinking is probably going to be closer to 4 to 4.1%. If we get to that 4.2%, look for some change in tunes from the hawks. New home sales were basically unchanged from last month at an annualized rate of 662,000 units. The media tried to put a negative spin on this report, but we believe that home sales that we'll be showing for the February are going to uptick a little bit because we had a little higher rate in that late January time period. Later this week, kind of the week that we have in front of us for data is Tuesday. We've got durable goods orders, but also home appreciation factors, Case-Shiller, HFHA, HPI, and Black Knight. Those will probably come through very positive, showing increased appreciation. Thursday, we have Q4 final reading for GDP. Now, that's going to be a very important reading. I guess it's going to be a little bit below what the original market had targeted it at. Also, we've got initial jobless claims and pending home sales. Friday is going to be the big one, personal consumption expenditure. I think we're going to get a little bit of a positive in that report. The replacement number that we've got is about 0.37, and the market's factoring in about a 0.25 inflation reading for the month. So that could help us out on overall core PCE. Stay tuned. Follow us here, the Market Update Desk, for all of your market news. We're the original source for this. Give us a call, 616-293-2189. We look forward to hearing from you, and we'll help you get pre-approved and get your offers accepted. Take care.